Hi friends, I hope so you all are fine. Welcome to my new video. In this video we will discuss about how to pick stock. So come to my Google screen and see here how to pick stock. 7 thing all beginner investors should know. How to do your homework before picking stock to buy. When you decide to try your hand at stock picking, it's essential to do your homework. Your goal is to find a good value, especially if you plan to hold on to an assist or a while before you put full faith in the company. You should do research by reviewing a stock fundamental or monitor its variability and checking it deserve a spot in your portfolio. This is not simple purchase. You are becoming a part of owner of a company. So investor must be willing to do a proper analysis. Here are 7 things you should know about a trader company before investing your hard earned cash. Trends in earning growth. Over time, do the company profits generally increase? If so, it's a pretty good that the company is doing something right. Even small regular improvement over a long period can be positive indicators, but earning growth and value have to go hard in hand in the stock to be worth the investment. You want to look at the company financial reporting available on the company investor relation website, Twitter hour, and the annual basics of examine whether revenue and earning are growing or decline. Companies that show positive earning growth tend to have financial and optional stability. You also want to understand the company plan to continue increasing earning. A company have as proven strategy to increase sales, attracts new customers, and developed new product could be on investing in. Company strength relatives in its speeds. Industry can be a great screen when investor starts by looking at how an industry is represented in the market and establish what growth potential look like in the space. However, when picking individual stocks within an industry, you need to look at where and how the company fits in. How does it fare against in competitors? What is the market share? Is there an advantages that allow it stand out? These critical questions can help to determine whether a company has an edge. To make a fair line up competitors to the same size of market capitalization to compare their profitability and stock performance over a period of time to understand their performance relate to another. Debit to equality ratio in line with industry norms. All companies carry debit, even some of the most profitable companies like Amazon.com, TikTokers, and Apple. Investors can use debit as an indicator to the company financial well-being. Watch out of companies with high debit levels to their equality as also as debit to equality ratio are merit used to measure a company total debit relates to market value to find the number to total list at the company balance sheet on the earning statement by the total amount of shareholders equality for investors with lower risk tolerance. That number should be zero point 0.3 or less according to industry experts. There are expansion, however. For example, look at the debit to equality ratio across industries. In the concentration industry, there are on debit funding on the higher ratio might be acceptable, but if debit is so high that could put pressure on profits, make sure you pick in line with industry norms as a complaining story to explain why is it. Price earning ratio can give an indication of valuation. The price earning or ratio is a valuation metric that show how well a stock price reflects the company earning when using fundamental analysis and value investing strategies. Ratio is one of the indicators of whether a stock of the undervalued or overvalued by the market. To find the price earning ratio, divide the company share price by its annual earning per share either over the past year or estimated over the coming year. For example, if a company is trading at $40 per share and the earning per share is $2.50 for the last year, the price ratio is 16, well below the average percentage ratio of an S&P 500 companies in Feb 2022. The ratio is a key way to compare companies in the small industry or sector. A company with a lower potential energy ratio is not valued as high by the market is one with a higher ratio. Your job as an investor is to determine whether the stock deserves that low value and whether the market is undervaluing it, which could make it a good stock pick. How the company treats the company that's paid dividend in often one with a degree of stability, especially if a company less increased its payout essential. If the company has increased its payout consistency each year over, but watch out the companies that have very high yield. Calculate by dividing higher worth of dividend by the stock price. A peak in dividend yields can mean a company is sitting and trying to attack or keep investors. That the incoming stream high dividend could also be the indicators that a company is not investing enough in itself. A company can temporarily or permanently cut its dividend or to secure more liquidity during challenging economic time. That does not essentially mean the company is rather in the business. Many require more cash to pay immediately expenses. Companies can dividend if they expense lower earning or short term unexpected expense, in which case they could retain or money that could have been distributed as dividend to address financial need, but it a short term problem because long term may have your position. If you like our video, please subscribe our channel. Thank you so much.